Your P&L says you made money this quarter, but it doesn't say why, where, or whether you can do it again. And that gap is the difference between running your numbers and understanding them. I'm Mike Hiley. I'm a chartered accountant and I spent almost 30 years in professional services, including 14 years at WPP. Most owners look at their profit and loss statement and they'll just ask one question: what did we make? But a CFO will ask at least 3 more questions, if not more. Why did we make it? Where did we make it? And can we repeat it? Because your highest cost is your people, not inventory or materials. And your profitability comes down to a handful of drivers: utilization, billing rates, realization, project mix, contractor use. A generic P&L will tell you what happened, but you want to know which driver caused it. Most business owners that we speak to are obsessed with revenue. It's all about the top line. We made $10 million last year and it grew by 15%. And $10 million is impressive, but there are 2 issues with this point of view. Number 1 is it tells you nothing about your business's profitability. And number 2, revenue growth alone is just a number and it tells you nothing without context. So don't stop just looking at revenue. Compare it against your budget, compare it against prior periods, and then check the quality of that growth. Is it recurring or is it just a one-off? Is it concentrated on a few clients? Did headcount drive it or was it due to improved productivity? And one number answers that last question directly. It's revenue per billable employee. You divide your revenue by your average billable headcount. If your revenue grew by 15% and your billable headcount grew by 25%, you need to ask yourself if your business actually got more productive or it just added more people. The next item to look at is gross margin, and that's revenue minus your direct delivery costs. Direct delivery costs are mainly billable employee costs, and don't forget taxes and benefits, and contractors. Track your gross margin percentage. And to find that, you just need to divide your gross profit by your revenue and compare it again against previous periods, against budget, and against service, if possible. Research from SPI Research put the average project margin at 37.7% in 2025. But treat that as a reference point, not a target to chase. Your own trends matter much more than matching a number. When your margin moves, you need to look for the cause. Was it due to lower utilization? Was it due to discounting? Was it poor realization? Was it because of project overruns or was it because of scope creep? Did pricing, productivity or delivery costs cause the move? That's what really matters. The biggest cost for any professional services firm is your people, but you need to split that into 2 groups. The delivery staff that generates revenue, which I spoke about before as part of the margin, or overhead staff that support the business, because that split makes your P&L a lot more useful. Overhead staff will still be a significant part of your indirect costs, so you need to track them carefully. We can't talk about profitability without talking about utilization, and utilization is your billable hours divided by your available hours. When it falls, the real cost of every billable hour climbs because you're paying your people whether their time gets billed or not. Again, research from SPI Research found that billable utilization fell to 66.4% and 25%. That's the lowest on record. Realization is different. It measures how much of your team's billable hours turned into cash in the bank. Your margin could fall even when your utilization is strong if your discount rates write off hours or you let projects overrun. Say your gross margin fell from 42 to 35%. Was it because utilization fell? Did realization fall? Or did your team mix shift towards more senior role? Which number explains the variance? Those are all CFO questions. Another thing is a company level P&L isn't enough. You need to break profitability down by client and project. If you can't see your client or project profitability, you're either using your ERP wrong or you need a new system. A large client can generate an impressive revenue number whilst demanding discounts or creating scope creep or producing frequent write-offs. So which revenue do you actually want? Because not all revenue is worth chasing. A profitable firm can still run into cash flow problems. For example, slow billing, late collections, growing receivables, and unbilled work in progress can all affect that. If you made $100,000 in profit this quarter but your cash flow only grew by $20,000, that's a CFO question. It's not an accounting definition issue. And we recently were brought in by an agency in New York to answer that very question. Let me give you an example. Picture a professional services firm with these results. Prior year revenue, $2 million. Gross margin, 42%. Billable headcount, 12. and utilization 75%. That all counts to an operating margin of 15%. In your current year, revenue is 2.4 million, so it's up by 20%. But gross margin is now 35%. Your billable headcount is 16. Utilization is 66%, and your operating margin is now 9%. A basic review stops at one line. Well, revenue increased by 20%. But here's the CFO read. Revenue increased by 20%, but billable headcount increased by 33%. Utilization fell by 9 points, and gross margin declined by 7. Operating margin fell from 15% to 9%. Run one number. Revenue per billable employee. In prior year, revenue was 2 million, so you divide by 12 and that gives you $167,000. In the current year, the 2.4 million revenue divided by 16 is 150,000. And that's a 10% fall, even though the total revenue grew. So you added 4 more people, but each one now generates less revenue and margin than your team did a year ago. Revenue growth told you almost nothing on its own. A CFO level review asks what operational drivers caused the number, not just what the number was. You don't need to become an accountant, but you need to understand your firm's economic engine well enough to make better decisions. Look, if you want a second set of eyes on your numbers, book a profit and capacity diagnostic now.